G'day everyone, welcome to the weekend general update for the 23rd and 24th of February. And last week we had a pretty pivotal week with a significant fall in the US market. Mind you, it was pretty overdue and our market followed through in even more emphatic style, which is kind of what we've got used to happening over the years. And then we saw some reasonable recovery into the end of the week. So it really poses a question about where to for markets in the very short term. So let's try and unravel that a little bit today. Just a reminder, this is general advice only. There's the licensing information there as well. So summary of the week, the S&P ended up losing 4 points on the week because of the rebound into the last couple of days. But technically what we've had is a false break of resistance, and so I think the odds favour the market perhaps coming back and correcting a little bit further. But I still think it will be a relatively shallow corrective phase and quite possibly not lasting any more than 1 to 2 weeks. There's no guarantees of that, of course, but I think that's where the odds sit at the moment. Now in response, our index lost 15 points. We had a huge negative day, but followed up with a pretty good day on Friday to regain quite a bit of the losses from the previous day. To me, Thursday looked like just a really massive overreaction on the Australian market, but such significant falls gets everybody a little bit nervous and a little bit jumpy, and so I really think now, even though we had a really solid rebound on Friday, I really think we're going to get a couple of weeks of correction, which is to my mind just brilliant because it'll set up opportunities to get into some great stocks at prices that have really been out of our reach now for a couple of months. And this was the largest single day move since May of 2012 in the Australian market, so it really was quite significant. Now just looking at US bonds, the yields continue to track a little bit higher, so there is a bit of an upward pressure on interest rates, and for that reason that's why I cannot see any possible way that the Fed is going to abandon QE or change it to any great extent, and that was really the trigger for the fall in the market. People were worried that they were going to stop printing money, and that's why gold fell sharply and why the stocks fell sharply. But the conditions are such, I just can't see there's any way that they're going to be able to do it. Now the US dollar rose significantly on the week. That was more a matter of euro weakness, I think, than anything else. And also we've got Japan, their currency devalued to a degree as well. So the US dollar index, which is an index against a basket of 6 currencies, has had a little bit of an upward trend to it. Gold lost another $30 on the week, so that's been a pretty nasty couple of weeks for gold. But so far it's got down to some key support, and also it's as oversold as it has been for quite some time, and at this level of oversold it's really where major bottoms are put in, so hopefully that's the case with gold. Now the stock indices also broke support and look particularly weak, so we really need to see a rebound there. Copper dropped from 375 down to 355 area in reaction partly to the US dollar going up, so that was part of it, but the other part of it of course was some concern over China, and we've seen that over the last year or two, and those concerns end up coming to nothing and the market just goes back up again. Oil dropped a couple of dollars down to 93. So I don't quite understand why the price of our petrol is as high as I've ever seen it. So someone's making some money somewhere. And there's the 6-month spot copper chart. You can see just how sharply that price has backed off just in the last couple of days. So let's jump in and have a look at some of the charts. This is the S&P 500. So we'll just pan back, get a big picture look. We've got resistance here at 1520, 1525, and then again up at 1575, which is the all-time highs. Now you can see that we had quite a strong trending line there that the market has been working off, and it had been quite a run since the 16th of November. Now you'll notice that we're getting some divergence on the RSI. In other words, the RSI has formed a lower high and a lower low, and while it's been doing that, the price has actually been rising. So that divergence is normally a very, very good indicator that we're going to get a little bit of downside in the market to correct that situation. So that's a technical reason why I think the odds strongly favour a bit more downside. Let's have a look at where that downside might go to. I think somewhere around about this area would be a pretty likely sort of area, so somewhere around about the 1466 area. And if we just pop some Fibonacci retracement levels on that, ties up reasonably well. So somewhere around about the 1460 to 1465 area I think is probably a pretty reasonable target area. That would get the S&P down to oversold, and I think that would probably clear the decks for another pretty solid run at 1560, 1570 area. Now, of course, that may not happen because there's just so much money on the sidelines in America, and valuations of American companies generally aren't that stretched. So it could continue on up from here, but I really think it's prudent to let's just watch for another few days, and I'd like to bet we're going to see this low of 1497 probably broken at some stage in this week coming. Now you'll notice I've got some highlighted here with some green boxes, some reversal points in the market. So we had some long shadows here, and again here and here. So all of these reversal points, and it took a few weeks for that to happen, but eventually the index rolled over until we got down to the trend line. We got another significant reversal here. You can see very distinct change in sentiment, and the market then went on a really strong run. Now we had a false break on Tuesday of that resistance. The market then abruptly fell back into the trading zone, followed through on Thursday. We had a little bit of a jump on Friday, but let's just see what it does over the next few days. And I think what it does over the next few days will tell us a fair bit about the likely course for the next few weeks. Taking a look at our market, this is the ASX 200. Equally a very powerful run. First of all from June, which is really when the banks took off. We then got a bit of a correction in late October, November, and then our market took off and was even more solid to the upside than the US market was. Now we've pulled back to a likely support and resistance area. You can see taking off this peak back here in April of 2011. So we've broken it, we've come back, we've tested it. So again, the next few days will be important for our market. Next we'll take a look at gold. This is gold on a daily chart, so you can see we've had a bit of a turnaround the last couple of days, but it's clearer if we look at this on a weekly chart, and we really are quite oversold at this level. And if we pan back and take a bigger picture look, whenever the RSI gets down to this extreme level, well under 30, you can see here was a bottom in the market. It took a few weeks for the gold to actually start to rise, but when it did, it went from 1550 to about 1800. And if we pan back even further to the last time gold was oversold, was way back here. So we're talking back here in 2008. That was really the start of a terrific run from 700 to 1900. So we certainly are in a zone where, and it's an important support area here, which could be a major bottom in gold. Let's look at it. It's a bit clearer on the weekly chart. The fall looked nasty over the last couple of weeks, but really when you look at it in big picture, it's still just playing out this big picture wedge pattern that's been forming now since gold hit a high. And if you look at the weekly RSI, you can see just how relatively oversold it is on a weekly basis. So when you pan back and take a really big picture look at gold over the last 15 years, you can see that this is not really that big a deal. We had 34 months to the upside. It's not surprising that we've had a rather extended consolidation period. So as long as that support doesn't break at around 1550, then we're still in good shape. Now looking at the GDX index, we had some important support here on the GDX at around about 40. That was a pretty important level. That got broken through the week, which is surprising and disappointing. So we may get a bit more downside in gold stocks yet, but really the valuations are so attractive at this point in time that there will be, I'm sure, quite a significant and sharp rebound to the upside. But there's no guarantees about where that might necessarily originate from. So that's it for this week. My feeling is just keep our head down for a few more days. Don't do a great deal, and let's just see how this correction's going to play out. So talk to you next weekend. Cheers.